Hello and welcome to Pro Trader Strategies Market Commentary for Monday, June the 26th. My name's Eric Wilkinson. Some of you may recognize me as the Wolfman from CNBC, Fox Business, or even the Wall Street Journal for my commentary on everything from economic to geopolitical and market analysis. Please keep in mind that everything that we talk about in these market commentaries is not a solicitation to buy or sell any of these securities or strategies. At the end of the day, we're here to teach you some different strategies you can implement into your portfolios, but please do that in your own way. The reason why I can't give you a recommendation on a particular stock or strategy is because I don't know your risk parameters, I don't know what's in your portfolios, and therefore what I'm doing could be counterintuitive to what you are already doing. Having that out of the way, let's get this on. Rare occasion, Monday, having some economic data that's actually important here in the United States. We got core durable goods orders came in at 0.1%, was expected to be 0.4%. Now, core durable goods orders is the value of new orders on the manufacturing side, excluding transportation. So excluding transportation came in slightly below expectations, but the core durable goods orders, which includes the transportation, came in much lower than expected at negative 1.1%, expected to be negative 0.5%. So 2 months in a row that number has been pretty bearish, if you will. So both below the line in the sand. So those coming off a little bit. We've got crude oil moving higher despite the fact that there's been some fodder out there talking about the surge in inventories. I haven't seen any economic data, nor have you probably, but at the end of the day, the market is pushing higher despite those high inventory numbers. Then on to gold futures. Gold futures finally relenting, actually getting back below that 50 Fibonacci level, breaking away from the point of control. I've been talking about this with the equities moving higher. That would indicate that gold might be a little bit overdone to the upside. We did get that tweezer top at that point in time, and we've started to see a steady slide. Now, the real point of contention for the bulls is going to be this Fibonacci level, for one, to keep it looking like there is newer highs and higher lows. So that would indicate a bull trend. If we break below that Fibonacci level, or even below this area of right around 1218-ish, 1215, let's call it, breaks below 1215, it's going to be looking pretty bearish, actually. 1215-ish. So those are the areas that if you're a bull, you need to defend, and if you're a bear, you really want to see it get below that. So then on to the bonds. Bonds continue to move higher despite the fact that equities are coming off. As a matter of fact, we're starting to look to see this 50-day moving average cross over the 200-day moving average, which would indicate even more of a bullish move. So now we've got this newer high. Market continues to just push higher and fading the Fed, if you will. With the Dow Jones, it's up about 46 points on the day, and the value area high has moved slightly higher for the Dow Jones Industrial Average, and we're really seeing a massive separation here. A lot of price being accepted at these levels. We're seeing down here there was not a lot of price being accepted. There was a lot of time just sitting there, but now people are putting their money where their mouth is, up in this area. So pretty soon we might see this whole shift from the time spent to up in this area as well. And then we'll see that whole chart kind of move out, but the value area high for the time is right here, and the value area low for the time is, or the volume I should say, is down around this area. So a lot of the volume being placed up and around this upper band. Then the NASDAQ just slightly in negative territory today, down about 7 points, mostly due to like Apple was looking pretty bearish earlier today, and some of those bigger tech stocks kind of coming off a little bit. People are kind of wondering whether or not people are really going to spend $1,000 for the new iPhone. So they're kind of seeing a little bit of weakness. Then with the E-mini S&Ps up on the day, so real mixed bag. Dow up, E-mini S&P's up, tech down, mostly because Apple is in there, but weird caveat to that is Apple's in the SPOOs and in the Dow as well. So, but the overall blue chips holding up the Dow Jones. Then with the E-mini S&Ps on a 15-minute chart, you can see on the economic data heading into that, we were trading very near the high, or trading at the highs of the day. That economic data points came out, and the overall markets just really kind of decided to take an about face on that once they started really digesting that data. Then Target, these are a couple of the trades that I've done. If you remember Target, I talked all last week. I had working orders in Target. Originally sold these, did the July 48 puts, originally sold them for 53 cents. Last week, all week, I was trying to get out of those for 50% of my max profit, right around 26, 27 cents. Never got hit on them. Today, put in an order, bought them back for 19 cents. So that theta decay and volatility being the directionality today really helped me out on that trade. So then on to Apple. Apple's a trade that I just decided it was looking pretty bearish, kind of topping out here. I think that we might see some profit taking going into the earnings that they're going to be having coming up after this earnings, or after this expiration cycle. As you can see, kind of flagging out a little bit. I think that it's going to kind of come back down and test these value area highs. So I decided to put on a put spread, shorter duration than I normally do for a debit spread, but I didn't want to be involved in the month with the earnings cycle. And I also wanted to add some negative deltas, so this one kind of fit the book on there. I went into the July, bought the 149 puts, and then sold the 142 puts to finance that, and paid a debit of $3.22. So that fits my rules on that kind of strategy. $7 wide, paying less than $3.50 on that strategy. So added that to my portfolio. Then with ULTA is another trade. They seem to be doing very well. And with ULTA, give me a second here. With ULTA, pull it up just to make sure I know what it was that I paid, or I did that trade for originally. I originally sold these July 260 puts in there for 90 cents, bought them back for 50% of my max profit on that, being 45 cents. So that trade took off as well. Got that move today, and was able to get out for 50% of my max profit on that. Then XOP, which is the oil and gas exploration fund, with the overall market kind of pushing higher here. I'm looking to add something in here. So I'm working the July 29 puts in there for 24 cents. So looking to sell those puts in there because it looks like we're getting a bit of a bounce, despite the fact that we're talking about those surge in the inventories, or possible surge in the inventories. And so I'm looking to take that trade off for right around 50% of my max profit. It's kind of getting away from me a little bit right now. Working it for 24 cents. It's trading around 30. Originally sold that for about 50 cents, but with this little bit of a pop, looking to try and get out. Looked a little bit better earlier this morning. All right, so now with XOP, this is a trade that I've had on for a little bit. Got this little bit of a bounce in here and trying to get out of it for right around 50% of my max profit. Was getting really close this morning. I guess I wanted the penny rather than the trade. And with the XOP, I did the July 29 puts. Originally sold them for 48 cents. Trying to buy them back for 24 cents. It's trading around 30 right now. So that one kind of getting away from me. I put that in when we got close to those highs. The stuff that I've been reading, the surge in inventories, the market's kind of fading that. I don't see any different other than a little bit of bearishness. So I've gotten that bounce. I'm going to be looking to take that trade off. And then with XRT, this trade, the retailers have been really beaten up found a nice bottom here, rallying up. I think it could go up and test this value area low. So with XRT, I'm looking to add some trades in here. Haven't gotten a hit on it yet, but with this, I'm looking at the July 38.5 puts and trying to collect a credit of 29 cents. That was a little bit closer this morning, but now that the market's continued to push higher, it's trading about a quarter. I haven't been chasing that one, but looking to add that trade also going forward. And then what is it? I think that's it. That's about all we got. I've gone through all of my lists right now, so hopefully we can get some of these XRT, because I think that the retail sector is due for a bit of a bounce here. Friday's webinar we're going to be doing on a poor man's covered put, which is the opposite of poor man's covered call. A lot of people look at the poor man's covered call, but this is going to be a way to synthetically short an underlying and have limited risk to the upside. It's going to have a synthetic call put in there, and this is a better way to utilize your capital if you want to short something than to go out there and short an underlying, and do a put against it and define your risk with a call. So or limit your losses with a call. So I'm going to show you how to build that out on Friday's webinar. So go to protraderstrategies.com and check that out. If you can't take that, take it easy.